Okay, the next special topic is business combinations. So business combination is when you acquire a target company, and when you do your financial consolidation, what happens is you bring assets at fair value. Now, when you bring assets at fair value, what that could mean is that in the economic entity, the deferred tax asset and liability could be different in relation to the subsidiary's asset, might be different from the deferred tax asset and liability recognized in the subsidiary's balance sheet. When that happens, WSB 112 says when you increase the DTA or increase the DTL, don't put it to income tax expense, post it against goodwill. Okay, so let's look at a simple example. Let's say company A acquired company B for $1 million. And the assets and liabilities of company B were as follows. So in company's B balance sheet, the stock was valued as 500,000 at cost. Annual leave is 50,000. So company B, when you apply tax effect accounting, you recognize a DTA on the annual leave. So 50,000 times 30% is 50,000. Okay, no temporary difference on its stock. Okay. So company A would, when it initially posts its journal entries for financial consolidation, it will recognize a goodwill initially of 635,000. So it pays $1 million for it, and minus the fair value of assets, fair value 400,000, not what's recognized in a subsidiary company B, the annual leave, the DTA, and the annual leave provision. So 635,000 for goodwill. However, you note that the economic entity has a different DTA because it's bringing the stock in at fair value. So there is a difference of 100,000 in the stock value. So there's a 30,000 DTA on the stock valuation. So carrying amount is 400,000 and the cost of the stock is 500,000. So this is what happened. Initially, I've got a goodwill of 635, but I need to increase my DTA by $30,000. Okay, for that stock. Now, when I increase my DTA, I don't post it against income tax expense. I adjust it against goodwill. So you can see that it's changed by $30,000. And the way we do this, when companies do this, is they might create a separate entity in their software to account for the business consolidation, for business combination entries. When that DTA unwinds, right, again, doesn't go to goodwill. When it unwinds, it goes to income tax expense. Okay, so, and this is extract from the CTS software. You can see that that entry goes against the acquisition column or goodwill column rather than hitting the P&L